Most investors are playing a game they don't even understand. They buy stocks hoping the price goes up. They sell when they get scared. They have no systematic approach, no principles, no understanding of how economic machines actually work. And then they wonder why they underperform year after year. I'm Ray Dalio. I've managed Bridgewater Associates for over 4 decades. We've navigated every major financial crisis since the 1970s, and I'm going to tell you why dividend-paying stocks are one of the most intelligent ways to build lasting wealth, especially if you understand the economic principles that drive them. Let me be clear about something from the start. I don't invest based on hope or speculation. I invest based on principles that have been tested across decades and different economic environments. Dividend stocks aren't just about getting a quarterly payment. They're about understanding the fundamental relationship between capital, cash flow, and economic reality. They're about building a portfolio that can weather any economic season. And most importantly, they're about aligning your investments with businesses that create real value, not just hype. Here's what most people miss. A stock is not just a ticker symbol that bounces around on a screen. It's a piece of ownership in a real business. When you own a dividend-paying stock, you own a piece of a company that generates profits and returns those profits to you as the owner. This is not theoretical. This is actual cash hitting your account. This is the only true measure of whether a business is creating value or just burning capital. Think about it this way. If you owned a local business, let's say a restaurant or a manufacturing company, you wouldn't judge its success by whether someone offered you more money for it tomorrow. You judge it by whether it produced profits that you could take home at the end of each month. That's cash flow. That's real return on investment. That's what matters. Dividend stocks operate on exactly the same principle. They return cash to you as an owner, regardless of what the stock price is doing on any given day. Now, I want to share something that fundamentally changed how I think about investing. It happened in the early 1970s when I was just starting Bridgewater. I watched the Bretton Woods system collapse. I watched the dollar decouple from gold. I watched inflation spike and the economy enter a brutal recession. And I learned something critical. Paper promises mean nothing if they're not backed by real productive capacity and cash generation. During that period, companies that paid dividends were the ones that survived and thrived. Why? Because they had real businesses generating real cash flow. They weren't dependent on credit markets staying open or stock prices staying elevated. They produced products people needed, generated profits, and returned those profits to shareholders. The companies that were just growth stories with no cash flow got destroyed. Their stock prices collapsed and never recovered because there was no underlying value to support them. This lesson shaped my entire investment philosophy. I became obsessed with understanding what creates real, sustainable value. And the answer always comes back to the same thing: productive capacity that generates cash flow. Dividend-paying companies are the purest expression of this principle. They can't fake it. They can't tell a story about future profitability. They have to produce actual profits today and return those profits to shareholders. The dividend check doesn't lie. Let me walk you through the mathematics of why dividends matter so much. There's a statistic that's been proven across multiple studies and time periods. Over the long term, approximately 70 to 80% of total stock market returns come from dividends and the compounding of those dividends, not from price appreciation alone. This shocks most people because they think stock returns come from buying low and selling high. But the data tells a different story. From 1926 through today, if you had invested in the stock market and reinvested all dividends, your returns would be exponentially higher than if you had only captured price appreciation. We're talking about the difference between a portfolio worth tens of thousands versus hundreds of thousands or even millions from the same initial investment. The power of compounding dividends is the most underappreciated force in wealth building. Here's why this works. When you receive a dividend and reinvest it, you're buying more shares. Those additional shares generate more dividends. You reinvest those dividends and buy even more shares. This creates a compounding loop that accelerates over time. In the early years, the effect is modest, but after 10, 20, 30 years, the compounding becomes explosive. This is what Albert Einstein allegedly called the most powerful force in the universe. And it's available to anyone disciplined enough to invest in quality dividend payers and reinvest those dividends consistently. Now, let me explain why dividend-paying companies are fundamentally different from non-dividend payers. When a company pays a dividend, it's making a commitment. It's saying to shareholders, we generate enough cash flow to return money to you regularly, and we're confident we can sustain this. This commitment forces discipline on management. They can't waste capital on empire-building acquisitions or vanity projects. They have to maintain the financial health of the business to support the dividend. Compare this to companies that pay no dividends. What are they doing with their profits? Some are reinvesting wisely in growth, but many are hoarding cash, making questionable acquisitions, or buying back stock at inflated prices to manipulate earnings per share. There's no discipline, no accountability to shareholders, no proof that the business model actually generates sustainable cash flow. I've seen this pattern play out thousands of times across different markets and economic cycles. Companies that establish a track record of paying and growing dividends tend to have stronger balance sheets, better management discipline, and more sustainable competitive advantages. They're the survivors. They're the businesses that compound wealth through economic expansions and contractions. This is not coincidence. This is cause and effect. Let me give you a framework I use to evaluate dividend stocks. I call it the sustainability triangle. You need three things: durable competitive advantage, consistent cash generation, and reasonable payout ratios. Let's break each of these down. Durable competitive advantage means the company has something structural that protects it from competition. This could be a brand that allows premium pricing like Coca-Cola or Procter & Gamble. It could be network effects like Visa or MasterCard, where the value increases as more people use the network. It could be regulatory barriers like utilities that operate as legal monopolies in their service territories. Or it could be high switching costs, like enterprise software where customers are locked in. Without a competitive advantage, profits get competed away and dividends become unsustainable. Consistent cash generation is exactly what it sounds like. The company needs to produce positive free cash flow year after year, regardless of economic conditions. I want to see this through multiple business cycles. Anyone can generate cash in a boom. The question is, what happens during a recession? Companies like Johnson & Johnson or McDonald's have proven they can generate cash flow through wars, recessions, pandemics, everything. That's the kind of consistency that supports dividend growth. Reasonable payout ratios are critical. The payout ratio is the percentage of earnings paid out as dividends. If a company is paying out 100% or more of earnings as dividends, that's unsustainable. There's no room for error, no capacity to grow the dividend, no buffer for tough times. I like to see payout ratios in the 50 to 70% range. This means the company is returning a meaningful amount to shareholders, but retaining enough to reinvest in the business and weather any storms. Now, let's talk about dividend growth, which is where the real magic happens. A company that pays a 3% dividend might not seem that exciting, but if that company raises its dividend by 7% annually, the yield on your original investment doubles in about 10 years. After 20 years, you're earning 6 times your original dividend. This is yield on cost, and it's one of the most powerful wealth-building concepts in investing. Let me give you a real example. Suppose you bought shares of a dividend aristocrat, a company that's raised its dividend for 25 consecutive years, or more back in the year 2000. You paid $20 per share, and the dividend yield was 3%, so you earned 60 cents per share annually. Fast forward to today. If that company grew its dividend by 6% annually, your annual dividend per share would now be around $2.60. Your yield on cost is over 13%, even though new buyers only get a 3% yield at current prices. You're earning over 4 times what you started with, and you never had to sell a single share. This is why I focus so heavily on dividend growth rates, not just current yield. A high current yield might look attractive, but if the dividend is stagnant or declining, you're not building wealth. You're just treading water and probably losing ground to inflation. But a moderate yield that grows consistently will compound into extraordinary income over time. This is mathematical certainty, not speculation. Let me address something that confuses many. Investors. The relationship between dividends and total return. Some people argue that dividends are irrelevant because companies could just retain earnings and reinvest them, theoretically creating more value for shareholders. This argument fails on multiple levels. First, it assumes management will reinvest capital wisely. History shows this is often not the case. Managers frequently destroy value through empire-building acquisitions, poor capital allocation, or simply letting cash accumulate on the balance sheet earning nothing. Dividends force discipline and ensure shareholders actually receive returns. Second, the argument ignores the time value of money and the power of compounding. $1 of dividends received today can be reinvested immediately. A theoretical dollar of value created through reinvestment might materialize years in the future or might never materialize at all. The dividend is real and certain. The potential future value from retained earnings is speculative. Third, dividends provide optionality. When you receive a dividend, you can choose to reinvest it, spend it, or invest it elsewhere. You're not forced to keep all your capital locked up in a single company's stock. This flexibility is valuable, especially as your financial needs change over time. Now, let me explain how dividend stocks fit into a properly diversified portfolio. Diversification is not about owning lots of different stocks. It's about owning assets that respond differently to different economic environments. I think about the economy as moving through 4 basic seasons: growth with low inflation, growth with high inflation, recession with low inflation, and recession with high inflation. Different assets perform well in different seasons. Dividend stocks are particularly valuable because they provide both growth and income characteristics. During periods of economic growth, the underlying businesses expand and stock prices appreciate. During periods of inflation, quality dividend payers can often raise prices and maintain real dividend growth. During recessions, the dividend income provides a cushion and reduces total portfolio volatility. This balanced performance across economic seasons makes dividend stocks a core holding. But I don't stop with just dividend stocks. I diversify across different types of dividend payers. I want exposure to different sectors because different sectors perform differently in different environments. Consumer staples like Procter & Gamble or Colgate-Palmolive do well in recessions because demand for basic products remains stable. Utilities provide consistent income and inflation protection through regulated rate increases. Healthcare companies like Johnson & Johnson benefit from demographic trends and inelastic demand. Financials like banks and insurance companies benefit from rising interest rates and economic growth. I also diversify across geographies. The United States has many excellent dividend-paying companies, but so do other developed markets. Canadian banks pay higher dividends than U.S. banks and operate in a more consolidated market structure. European companies often have different dividend policies and exposure to different economic cycles. Asian companies provide exposure to faster-growing economies. Global diversification reduces your dependence on any single country's economic performance. Real estate investment trusts deserve special mention in any discussion of dividend investing. REITs are required by law to distribute 90% of their taxable income as dividends. This creates very high yields, often in the 4 to 7% range. But not all REITs are created equal. I focus on REITs that own essential property types with long-term demand drivers. Healthcare REITs benefit from aging demographics. Data center REITs benefit from the digitization of everything. Cell tower REITs benefit from the build-out of wireless networks. These aren't speculative plays. These are infrastructure assets with decades of visible demand. Let me share my framework for building a dividend portfolio from scratch. If I were starting today with the goal of generating reliable income and long-term growth, here's exactly what I'd do. I'd allocate 40% to dividend aristocrats and kings. These are companies that have raised their dividends for 25 or more consecutive years. This is an elite group. It includes companies like Johnson & Johnson, Procter & Gamble, Coca-Cola, 3M, McDonald's. These companies have proven they can grow dividends through every economic environment imaginable. They're the foundation of the portfolio. Rock solid, reliable, boring in the best possible way. I'd allocate 25% to high-quality dividend growers. These are companies that might not have 25 years of dividend growth yet, but they're on that path. They're growing dividends at high rates, often 10 to 15% annually. They have strong competitive positions and secular growth tailwinds. Companies in this category might include Visa, MasterCard, Microsoft, or Broadcom. These provide higher growth potential while still maintaining dividend discipline. I'd allocate 20% to high-yield dividend payers. This includes REITs, business development companies, utilities, and telecoms. These provide the current income that makes the portfolio functional for someone who needs to live off the dividends. Yes, they're riskier than the aristocrats, but diversified across 10 or 15 positions, the risk is manageable, and the yields of 5 to 8% are hard to find elsewhere. I'd allocate 10% to preferred shares. Most investors don't understand preferreds, which is exactly why they offer value. Preferred shares are hybrid securities that pay fixed dividends and sit senior to common stock in the capital structure. They offer yields in the 5 to 7% range from investment-grade companies. They're less volatile than common stocks, and they provide diversification benefits. I particularly like preferred shares from banks and insurance companies during periods of rising interest rates. The final 5% I'd keep in cash or very short-term treasuries. This serves two purposes. First, it's your opportunity fund. When markets panic and quality dividend stocks go on sale, you have dry powder to deploy. Second, it's your emergency buffer so you never have to sell stocks at the wrong time to meet living expenses. That's the portfolio structure. 40% aristocrats, 25% dividend growers, 20% high yield, 10% preferreds, 5% cash. This portfolio should yield somewhere in the 4 to 5% range currently. And if you're reinvesting dividends, the dividend growth should compound at 7 to 10% annually. Over time, this creates a powerful wealth-building machine. Now, let me address the tax efficiency of dividend investing, because this matters enormously. Not all dividends are taxed the same. Qualified dividends, which are dividends from U.S. corporations and certain foreign corporations held for specific periods, are taxed at long-term capital gains rates. For most investors, that's 15 or 20%. This is significantly lower than ordinary income tax rates, which can be 37% or higher. Compare this to bond interest, which is taxed as ordinary income. If you're in a high tax bracket and you're choosing between a bond yielding 4% and a dividend stock yielding 4%, the after-tax income from the dividend is substantially higher. This tax advantage makes dividends even more attractive for taxable accounts. There's another tax advantage that's less understood. Dividend growth provides a form of tax-deferred compounding. When your dividends grow from 3% to 6% to 12% on your original cost, you're building wealth without triggering any additional taxes. You only pay tax on the dividends as you receive them. The appreciation and yield on cost happens without any tax consequence. This is enormously powerful over long time horizons. Now, let me talk about the behavioral advantages of dividend investing. One of the biggest challenges in investing is controlling your emotions. Fear and greed destroy more wealth than any market crash. Dividend investing helps manage these emotions in several ways. First, dividends provide positive reinforcement during bear markets. When stock prices are falling and everyone's panicking, you're still receiving dividend checks. This makes it psychologically easier to hold through volatility. You're getting paid to wait for the recovery. Second, dividend investing reduces the temptation to trade. If your investment thesis is based on receiving and growing dividend income, you're not constantly checking stock prices and making impulsive decisions. You're focused on the cash flow, which changes much more slowly than stock prices. This naturally encourages long-term thinking. Third, dividends provide a concrete measure of progress. It's easy to get discouraged when your portfolio value fluctuates. But when you see your annual dividend income growing from $10,000 to $12,000 to $15,000, you have tangible evidence your strategy is working. This builds confidence and commitment to the process. Let me share some specific criteria I use when selecting individual dividend stocks. These are my non-negotiables. If a company doesn't meet these standards, I don't invest, regardless of how attractive it might look otherwise. Criteria number 1, at least 10 years of dividend payments without a cut. I want proof the company can sustain dividends through a complete economic cycle. 10 years covers at least one recession. If they maintained or grew the dividend through that recession, they pass the first test. Criteria number 2, dividend payout ratio below 75%. This ensures there's a cushion for tough times and room to grow the dividend. Companies paying out everything or more than they earn are living on the edge. One bad year and the dividend gets cut. Criteria number 3, positive free cash flow growth over the past 5 years. I want to see the business generating more cash over time, not less. Declining free cash flow is a warning sign that competitive advantages are eroding or the business model is under pressure. Criteria number 4, return on equity above 12%. This measures how efficiently the company generates profits from shareholder capital. Low returns on equity suggest a mediocre business. High returns suggest strong competitive advantages and good management. Criteria number 5, reasonable valuation. I won't overpay even for a great company. I look at price to earnings ratios, price to free cash flow ratios, and dividend yields relative to historical averages. If a stock is trading at twice its normal valuation, I wait for a better entry point or move on to other opportunities. These 5 criteria filter out probably 90% of the stock market, but that's fine. I'd rather own 20 excellent companies than 200 mediocre ones. Concentration in quality is far superior to diversification across garbage. Let me address a common objection to dividend investing. The argument that companies which don't pay dividends can create more value by reinvesting in growth. Amazon is often cited as the example. They never paid a dividend, reinvested everything in growth, and created enormous shareholder value. This is true, but it's also survivor bias. For every Amazon, there are hundreds of companies that promised growth, retained all earnings, and destroyed shareholder value. The success stories are memorable. The failures are forgotten. The data shows that on average, companies that pay dividends outperform companies that don't. The discipline of paying dividends weeds out the value destroyers. Furthermore, Many of the best performing companies in history paid dividends even while growing rapidly. Microsoft, Apple, Visa, Johnson & Johnson all paid dividends during their high growth phases. The dividend didn't prevent growth. It ensured management stayed disciplined about capital allocation. I'm not against owning some growth stocks that don't pay dividends, but they shouldn't be the core of your portfolio, especially if you're focused on building sustainable income. A small allocation to high conviction growth plays is fine, but the foundation should be dividend-paying businesses with proven cash generation. Now let me explain how to think about dividends in different interest rate environments. This is critical because interest rates affect everything in the economy, and most investors don't understand the relationships. When interest rates are low, dividend stocks become more attractive relative to bonds. If 10-year treasuries yield 2% and quality dividend stocks yield 4%, the choice is obvious. This drives money into dividend stocks and supports valuations. When interest rates rise, dividend stocks face headwinds. Higher bond yields provide competition for investor capital. Also, many dividend stocks, particularly utilities and REITs, are sensitive to rising rates because they carry debt. Higher interest costs can pressure profitability and dividend coverage. But here's what most people miss. Rising interest rates usually occur during periods of economic growth and rising inflation. In this environment, the best dividend stocks actually benefit. Banks and insurance companies earn more on their float. Companies with pricing power can raise prices and maintain profit margins. Dividend growth accelerates. So while the stock prices might be volatile in the short term, the long-term dividend growth often more than compensates. The key is to own dividend stocks that benefit from rising rates, not just yield-sensitive utilities and REITs. Diversify across financials, industrials, energy, materials. These sectors tend to perform better when rates rise. Balance them with more defensive sectors like healthcare and consumer staples. This creates a portfolio that can perform across different rate environments. Let me share my perspective on dividend cuts, because this is something every dividend investor will experience eventually. Even the best companies sometimes face circumstances that force dividend cuts. The financial crisis of 2008 and 2009 saw many previously reliable dividend payers cut or eliminate dividends. The pandemic in 2020 caused cuts across multiple sectors. Here's how I think about dividend cuts. First, distinguish between temporary business disruption and permanent impairment. During the pandemic, many companies cut dividends not because their business models were broken, but because of temporary regulatory pressure or extreme uncertainty. Banks were strong, but regulators wanted them to preserve capital. Energy companies faced unprecedented demand destruction. Many of these companies restored and even grew dividends once conditions normalized. Permanent impairment is different. This is when the competitive advantage has been destroyed. When you see this, you sell immediately. Don't hope for a recovery. Don't average down. The dividend cut is telling you the thesis was wrong. Move on. Second, diversification protects you from individual dividend cuts. If you own 25 dividend stocks and one cuts its dividend, your total income drops by 4%. Disappointing, but not devastating. If you own 3 dividend stocks and one cuts, your income drops by 33%. That's a crisis. Diversification isn't optional in dividend investing. Third, focus on dividend sustainability metrics. Watch the payout ratio. Watch free cash flow trends. Watch debt levels. These indicators usually warn you before a cut happens. If the payout ratio is creeping above 80% and free cash flow is declining, reduce the position before the cut is announced. Let me explain my approach to international dividend stocks. Many investors stick exclusively to U.S. stocks because of familiarity bias. This is a mistake. Some of the best dividend opportunities exist outside the United States. Canadian banks are a perfect example. Royal Bank of Canada, Toronto-Dominion Bank, Bank of Nova Scotia. These banks operate in an oligopolistic market structure. There are only 5 major banks in Canada, and they're protected by regulatory barriers. They're extremely profitable and pay dividend yields often 50 to 100% higher than comparable U.S. banks. They've maintained dividends through multiple crises, and they provide geographic diversification from U.S.-specific risks. European companies often have different dividend cultures. Many European companies pay dividends annually rather than quarterly. Some have very high payout ratios because they view returning cash to shareholders as a primary obligation. Companies like Nestle, Unilever, or Diageo offer exposure to global consumer brands with long dividend histories. Asian markets present interesting opportunities, particularly in sectors like telecommunications and utilities, where monopolistic structures exist. Singapore telecommunications companies, Hong Kong utilities, Australian banks all offer attractive dividend yields and exposure to different economic cycles than the U.S. The key with international investing is understanding the tax implications. Foreign dividends often have withholding taxes that reduce your net yield, and currency fluctuations can impact your returns. But despite these complications, international diversification improves your portfolio's resilience across different economic scenarios. Let me address the role of dividend reinvestment plans, or DRIPs. These are programs where your dividends automatically purchase additional shares instead of being paid in cash. Many companies offer DRIPs with no commissions and sometimes at a slight discount to market price. DRIPs are powerful tools for wealth accumulation. They automate the reinvestment process. They eliminate the temptation to spend dividends. They enable true compounding, and they use dollar-cost averaging, buying more shares when prices are low and fewer when prices are high. But DRIPs also have disadvantages. They can create tax complexity because you need to track the cost basis of all those small share purchases. They reduce your flexibility because the dividends are automatically reinvested in the same stock rather than being redeployed where opportunities are best. And they can lead to overconcentration if one position grows to dominate your portfolio. My approach is to use DRIPs selectively. For my highest conviction, long-term holdings, I enable DRIPs and let them run for years or decades. For positions I'm less certain about or that are already large enough, I take dividends in cash and manually redeploy to opportunities with better value. This gives me the benefits of automatic compounding where I want it while maintaining control and flexibility. Now let me discuss the importance of dividend safety analysis. Not all dividends are created equal. Some are rock solid, others are at risk of being cut. Learning to distinguish between them is critical. I analyze dividend safety using several metrics. First is the payout ratio, which I've mentioned, but I look at it multiple ways. Payout ratio as a percentage of earnings, payout ratio as a percentage of free cash flow, and payout ratio as a percentage of funds from operations for REITs. Sometimes earnings and cash flow diverge significantly due to accounting. I trust the cash flow metric more. Second is the trend. Is the payout ratio stable, rising, falling? A rising payout ratio is concerning. It means dividend growth is outpacing earnings growth. This is unsustainable. I want to see stable or falling payout ratios, which indicate the company is generating earnings faster than they're increasing the dividend. Third is the balance sheet. How much debt does the company carry? What's the interest coverage ratio? Can they service their debt and still pay the dividend even if earnings decline? Companies with too much debt and thin interest coverage are vulnerable to dividend cuts if business weakens. Fourth is the dividend history. How many consecutive years of dividend growth? Have they ever cut the dividend? If so, under what circumstances? Companies that have never cut are obviously preferred, but sometimes a cut is acceptable if it occurred during an extraordinary event like the Great Depression or World War II. Fifth is the industry dynamics. Is the company in a declining industry or a growing one? Does it face existential threats from technology or regulation? Even if the current financials look fine, secular headwinds suggest the dividend might not be sustainable long term. Let me share my thoughts on dividend taxation in retirement accounts versus taxable accounts. This is a decision point that confuses many investors. In tax-deferred accounts, like traditional IRAs or 401ks, dividends grow tax-free until withdrawal. Then everything is taxed as ordinary income. This is ideal for high-yield dividend stocks where you're generating a lot of current income that you want to reinvest. The tax deferral allows maximum compounding. In Roth IRAs, dividends grow tax-free and withdrawals are tax-free. This is the ultimate account for dividend investing. Load your Roth with the highest growth dividend stocks you can find and let them compound for decades completely tax-free. In taxable accounts, qualified dividends receive favorable tax treatment, but you pay taxes each year as you receive the dividends. This makes taxable accounts better suited for tax-efficient dividend stocks, meaning aristocrats with lower current yields but strong growth. My strategy is to place high-yield assets like REITs and business development companies in tax-deferred accounts, place the highest growth dividend stocks in Roth accounts, and place tax-efficient dividend aristocrats in taxable accounts. This optimizes the tax efficiency of the overall portfolio. Let me conclude with the principles that guide my approach to dividend investing. These are the non-negotiable truths I've learned over 40 years of studying markets and managing money. Principle 1, cash flow is reality. Stock prices are perception. Focus on businesses that generate real cash and return it to shareholders. Principle 2, compounding works miracles, but only if you give it time. Dividend investing is a decades-long strategy, not a quarterly trading tactic. Principle 3, quality beats yield. A mediocre yield from an excellent company is superior to a high yield from a questionable one. Principle 4, diversification protects you from the unknowable. No matter how confident you are, spread your risk across multiple companies, sectors, and geographies. Principle 5, discipline defeats emotion. Have a systematic process for selecting, monitoring, and selling dividend stocks. Don't make decisions based on fear or greed. Principle 6, reinvestment creates wealth. The longer you can reinvest dividends rather than spending them, the wealthier you'll become. Principle 7, taxes matter. Structure your dividend investments to minimize tax drag. Principle 8, continuous learning is essential. The best dividend investors are always studying companies, industries, and economic trends. Never stop learning. These principles have served me well through multiple market cycles, recessions, periods of inflation and deflation, bull markets and bear markets. They're based on fundamental economic truths that don't change. Companies that generate cash flow and return it to shareholders create wealth. It's that simple and that powerful. Dividend investing is not exciting. You won't have stories about 10-baggers or meme stocks, but you will have a portfolio that generates growing income, compounds wealth reliably, and lets you sleep at night. For most investors, that's exactly what they need. The exciting strategies are usually the ones that destroy wealth. The boring strategies are the ones that build it. I'll take boring and rich over exciting and poor every single time.